Corporate profits have never been fatter or accounted for a bigger portion of the overall U.S. economy. We're going to dig a little deeper into that now with our chief equity strategist and economist, John Blank. John, without getting too technical here, what are the main reasons for this?
Terry, we've been looking at it, talking about the 7% annual, 7.5% annual core CPI, consumer price inflation rate rise, on endless numbers it shows in and outside the company. But and we've also been talking about the collapse of consumer confidence because wage rates are not keeping up and real spending, improvement is not happening for people. But what people fail to realize is there's another, chink in the armor here, which is what it means is these big companies are making bank. They're they're banking big, big profits because they're not paying people in an accelerating way. The way prices that they're getting from the market are rising. So the corporate profits are absolutely astronomically high relative to any period of time I've looked at, relative to the exclusion or inclusion of any of the adjustments that are made. So that's the point about CPI rises, that in this early first stage when wages do not keep up, that profits are just spectacular for these companies.
According to published Bureau of Economic Analysis figures, U.S. corporate after-tax profits recently made up about just under 12%, 11.7% of the GDP. This at a time of rising inflation with consumers paying more for goods. What does this imply for the U.S. economy?
Well, just if you think about it, Terry, from 100% to 12%, this tells you that the average profit margin is around 12% on whatever you see in the marketplace. So, be it a $2,000 a month, rental apartment, $200 of that is going straight to some profit, and that's economic profit. That's after all these other factors that played out. So, it just tells you that for whether you like it or not, one of the rising elements of activity and strength to stocks is just the sheer amount of profits that are cycling out there.
What's the inside story here, or the straight story about wages?
Well, that's the other story here. Is we got, obviously, the second part of this is that people are trying to hire for all that extreme activity, and that the wages start getting bid up at the same rate that price inflation is. So that's the next stage of this. But how long and how soon and how fast and how aggressive that move in wages is to be determined. And this is what kind of will likely take what's called profit margin compression to start happening. Well, we will just kind of chip away at that big amount of profits that have been earned.
Then there's the projection now of 5 rate hikes this year, up from an earlier projected 4. So does everything that we've talked about here, including the rate hikes, have a negative impact on the U.S. GDP going forward?
Well, they will, but people got to remember that it takes 12 to 18 months for rate hikes to play out in the U.S. economy through the fixed direct investment and portfolio channels. So what that means is, we are playing in 2022 with last year's, strong accommodative liquidity of 2021. And really what these rate hikes imply are what's going to happen in 2023 and beyond. So this has kind of been lost to the marketplace, that this latest stock market correction is not actually pricing in these rate hikes. They will start pricing those in next year.
So is the bar for economic growth being set lower?
It's pretty good, Terry. I mean, I look at most of it, and you're still looking at 3% annualized real GDP growth in the United States, and that's still above trend. So I think relative to long-term trend, it's still going to be a strong year.
Do you think we could see more changes to Fed monetary policy if inflation continues upward?
Well, here's the thing about inflation. A lot of it was driven by the supply shutdowns that the countries of the world undertook, either because they had to or because COVID caused them to. And then also the people, being shut down, buying more goods and not services, and then driving all those prices up. So the Fed funds rate or any other funds rate in a policy context is, going to slow demand down eventually, but it's got nothing to do with supply shortages and COVID restrictions that are also part of the equation. Remember, it is always demand and supply, and rates only manage demand. So this is the part that is, again, beguiling the markets, is that as, cases stay down after Omicron disappears, all the requirements, restrictions get dropped, that actually can lower inflation in its own right.
What do you see currently then as the main economic risks, both here and globally?
Well, the big risk here, actually, Terry, is that people talk the Fed into raising rates very aggressively because they're worried about inflation, and they underprice the supply effects that are coming from ending COVID, and that we get some kind of overdone discussion of rates. I personally would prefer the Fed stick to 4 to 5 every other meeting cycle right now, just simply because we don't have that much overvaluation anymore in the stock market, by the way. And when uncertainty falls, that lowers the amount of premiums that are baked into prices, and that can lower rates and rate outlooks and consumer prices. So I think that needs to be kept in mind.
Do you see the Russia-Ukraine situation as more of an impact to the markets versus the economy?
I think it's this is one of those subjects that we try to bake into markets, but the Ukraine stock market, the Russian stock market, and frankly even the East European ones that are tied to this whole thing are very unlikely to play out a very dramatic effect. So it's basically much more about longer term issues. And by the way, strengthening NATO and strengthening the relationship between the United States and Europe is actually a long-term benefit of this whole thing.
Strong buy stocks to be aware of now, you think, include ST Microelectronics, BP, and Asbury Automotive Group.
Yeah, let's go through Asbury Automotive. Obviously, this is your retail auto buyer thing where we're still seeing strong prices in this market. We talked about profitability. This is actually a group that's reaping some of those profits because they're being able to sell cars at a nice rate. BP, this is your international oil conglomerate. We got oil prices on the WTI over around 100 shortly, I would expect, and I would expect that's kind of spiky. So I would be a seller of BP now on the end of the rise in the oil prices, as we've spoken to how these things can roll over now. And then ST Micro, I think here's a supply chip shortage. This is where you're likely again to see some price compression, but you're going to see it only as these supply shortages get released. So the revenue growth of an ST Micro is very strong. So I still like the chips.
Our chief equity strategist and economist, John Blank, sizing up corporate profits and the economy. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.